There's a particular kind of anxiety that doesn't arrive loudly, it doesn't announce itself, it settles quietly at the kitchen table. It shows up in the middle of a Tuesday afternoon when someone opens a letter they weren't expecting, or reads something on their phone that they then put down and don't quite return to. And I keep coming back to this image of older people across Britain, people who have done everything right, who saved, who planned, who trusted, now sitting with a low-level unease about something that should feel completely routine, their bank account, their money, their independence, because that's what this is really about, not the technical language, not the regulatory frameworks, the independence. What's happening, and it's worth explaining this carefully, is that UK banks are being required, under updated anti-money laundering and dormancy legislation, to flag and in some cases freeze accounts that show unusual patterns of inactivity or that haven't completed certain identity verification checks by a fast-approaching deadline. June, that's the timeline being circulated now. And I think the instinct when you first hear this is to say, well, that's sensible, that's about protecting people. Fraud is real, dormant accounts are exploited, identity theft is a genuine problem, all of that is true, but then you sit with it a little longer and you start to think about who this actually affects in practice. The thing people are starting to notice is that these rules, designed in glass offices by people thinking about criminals and bad actors, land very differently on someone who is 82, lives alone in a house in Lincolnshire or Fife, doesn't use online banking, and hasn't updated their details with their bank because their bank used to have a branch in town and then it closed and they haven't quite worked out what to do since. That person isn't a money launderer, that person isn't a fraudster, that person is navigating a financial system that has slowly, almost without anyone noticing, been redesigned around people who aren't them. And now that system is preparing to freeze their account. It's strange because if you asked most people, most ordinary, reasonable people, whether they think banks should penalize elderly customers for not completing a digital verification process they may not have the means, confidence, or support to complete, the answer would be, of course not, obviously not, that's absurd, and yet here we are. You can almost feel the gap widening between the people who wrote the policy and the people the policy will reach, between the language of compliance and the lived reality of someone who isn't online, or who is online but finds it confusing, or who did receive a letter but didn't understand that it required action because the letter was written in the particular dialect of bureaucratic English that almost no one actually reads with full comprehension. There's a dignity question here that I don't think is being asked loudly enough. Because what does it mean, what does it say when the financial infrastructure of a country begins to function in a way that systematically excludes people who are older, less digitally connected, more likely to be living alone, more likely to have fixed incomes and fewer resources? That's not a technical failure, that's a values failure. It's a question about who the system was built for and who it assumes you are. And honestly, I think there are two things happening at once, and they're worth separating. There's the immediate practical problem, people who are going to wake up in June and find they can't access their money, through no fault of their own, because a process they didn't fully understand has been completed without them. That's urgent. That needs intervention from banks, from the Financial Conduct Authority, from advocacy groups, from families, from MPs. It needs clear communication, accessible support, and exemptions or extensions for those who need more time. But there's the slower, deeper problem, the one that doesn't get solved by a phone call to the bank. That's the question of what we're building, what kind of financial world we're constructing, and whether the people designing it are pausing long enough to ask, does this work for everyone? Not just the median customer, not just the person we assume is engaging with us online, everyone. The conversation seems to be shifting toward a broader reckoning with digital exclusion. There have been reports, committees, think pieces, warnings for years now about the pace at which essential services are moving online, while a significant portion of the population, not a fringe, a genuinely significant portion, is being left behind: banking, healthcare, benefits, government services. And each time the response tends to be, we'll provide alternatives. There are phone lines, there are in-person options. We haven't forgotten the people who aren't digital, and then the branches close. The phone lines have 45-minute wait times. The in-person options require getting there. I keep coming back to the question of what trust means in this context, because pensioners, by definition, are people who have been in a relationship with their bank for decades, in many cases, longer than most of the people now working at that bank. They have given their institution their loyalty, their savings, their financial lives. And the institution is now, however, unintentionally sending them a message: we didn't design this for you, and if you can't keep up, the system will move without you. There will be people who say, and this is worth engaging with, that the rules exist for good reason, that banks cannot simply ignore regulatory requirements, that the fraud risk is real and the costs of inaction are also real. All of that is true. Nobody serious is arguing for banks to abandon financial crime protections. But there's a difference between the existence of a rule and the implementation of it, and the implementation, the timeline, the communication, the assumptions baked into the process, the absence of any obvious safety net for those who fall through. That's where the failure is. That's where someone had a choice, and the choice they made may not have been the right one. And maybe that's the point, in a way. Not that anyone is malicious, not that anyone sat in a room and thought, let's make this harder for elderly people. The failure isn't usually that deliberate. It's quieter than that. It's the failure of not stopping to ask the question, of assuming that because most customers can navigate this, all customers can, of moving forward with a policy because the policy in the abstract makes sense, without thinking carefully enough about where it lands in practice. There's a human side to this that I find genuinely moving, and I don't mean that sentimentally. There is something particular about the vulnerability of someone who is old, and perhaps alone, and perhaps grieving a spouse, a life, a version of the world they understood, now being told that access to their own money is conditional on completing a process they don't fully understand, by a deadline they may not have been clearly told about, through a channel that doesn't really work for them. That is not a small thing. That is not just inconvenience. For some people, that is the difference between dignity and despair, between independence and a phone call to a child asking for help in a way they hoped they'd never have to. And I think when we're thinking about this, we have to hold that in our mind, not as an edge case, not as the unfortunate exception, as the reality for a meaningful number of people. People who built this country, people who paid in, who stayed, who kept faith with institutions and systems that are now, in their final chapters, making things harder in ways that feel and may actually be quietly unjust. What happens after June will tell us something about whether the banks respond to the pressure being applied, and there is pressure now from consumer groups, from MPs, from the media, or whether this becomes one of those situations where the rules simply unfold as written, and the accounts are frozen, and the phone lines ring, and the stories emerge gradually, quietly, in local papers and in community centers, and in the conversations of adult children realizing their parent has been cut off from their own savings. And maybe that's the version of this we avoid. Maybe the intervention comes in time. Maybe the communication improves, the deadlines flex, the banks deploy the kind of empathy and common sense that their PR departments would certainly claim is central to everything they do. I hope so, I genuinely do. But there's this growing feeling that the system, left to its own logic, doesn't naturally produce that outcome, that it takes pressure and attention and a willingness to say out loud, clearly, that this particular policy, applied in this particular way, is failing people who deserve better. That's the question in the end. Not whether the rules are technically necessary, but whether we are capable as a society of applying rules with enough humanity to ensure that the people most likely to be hurt by them are also the people most likely to be protected. And I'm not sure we've answered that yet. I keep coming back to that image of the kitchen table, the letter, the unease, and I wonder how many of those moments are happening right now, quietly, unreported, uncounted, while the system moves forward, more or less as planned.